Hello, everyone. This is Zak Gardezy. I'm the managing partner and private wealth advisor at Wealthstone Private Wealth Management. I'm also a certified financial planner and the host of Money Minutes. Here on Money Minutes, I like to cover the latest market headlines along with my outlook for what's ahead. And so let's get right into it. So, of course, some of the biggest news is all about what's happening in the Middle East right now. We had the Iran-Israel conflict really pick up, and then last week we had Israel respond by directly attacking Iran. And so as a result, and as I mentioned last week on last week's episode of Money Minutes, the conflict could really go one of two ways. You could have Israel respond in a very forceful manner, causing a lot of damage to Iran, which would then further escalate tensions. Iran would respond, and then there's no telling how much more escalation could have happened from there. But thankfully, another scenario occurred, which was an Israeli response that wasn't very severe and was really more of a political statement. And really both sides sent political statements to each other and saying, look, we're going to respond, but we're going to cause very little damage, and we'll probably even telegraph what we're going to do to really avoid causing significant damage. And so it seems now that that conflict has de-escalated or is continuing to de-escalate, likely moving back into the proxy setting it was in before. And so from a market's perspective, we saw oil prices come down, and we also saw the volatility index come down with it. And so it's exactly the type of scenario that the market needed to get that sigh of relief, because there was a lot of concern heading into last week about where this conflict could eventually go. And so thankfully, the latest update I have on the Iran-Israel conflict is that things seem to be de-escalating. So all focus seems to be on earnings right now, and that makes a lot of sense. We're really in the thick of it. And when we look at some of the weird stuff that's been happening with earnings, especially near the end of last week with super microcomputers, I mean, that was a really odd situation. So they decided not to pre-announce their earnings. And so the market did not like that. Being that they're newer to the S&P 500 and that's outside of their normal behavior, the market took that as a sign that Supermicro potentially has some really negative news to announce. The stock sold off, lost over 20% in one day, and because of their close association with NVIDIA, NVIDIA lost 10% in one day. And NVIDIA being the huge company that they are, 10% loss for them is equal to a $200 billion market cap loss. To put that into perspective, the entire market cap of McDonald's is about $200 billion. So basically in one day, NVIDIA lost in market cap value the equivalent of the entire McDonald's franchise. I think that's absolutely incredible, and just goes to show just how big NVIDIA's gotten over the last few years. Now, moving on to the rest of earnings, this week, it's a huge Magnificent Seven earnings week. We've got Tesla reporting at the end of the day today. We've also got Meta, Microsoft, Google reporting this week. And the Magnificent Seven is really shaping up to be a huge player and important factor in the markets. When we look over the expectations from FactSet for year-over-year earnings growth for the Magnificent Seven, the expectation is about 63% year-over-year growth. When we look at the rest of the S&P 500, it's a negative 6% year-over-year earnings growth. So that just really shows you how impactful the Magnificent Seven is and how much growth they're bringing to the S&P 500. And Tesla, their earnings is going to be a really important note for today, just because the stock has dropped over 50% from its all-time highs, and there's a lot of concern with Tesla. It's really, I think, going to boil down to what's Elon's guidance going to be for the rest of the year for the company. I mean, there's a lot of issues going on right now, from the latest Cybertruck recalls, scrapping plans about the Model 2, this talk about the robo-taxi, and, regulators aren't really informed as to what the plans are there. So really, there's a lot going on this week, and earnings is going to be a key focus, I think, for the rest of the week. So Treasury yields are up, and that has a lot of implications for the market. And right now they're hovering around 4.6% for the 10-year Treasury. So some elevated levels, and kind of reminds us of October of last year where the 10-year hit 5%. And so why is the 10-year up? Well, really it boils down to the market's expectations around inflation. The market's now considering that inflation could potentially move higher or remain elevated. And this also plays into the Federal Reserve's decisions. If inflation continues to move in this, really I consider the wrong direction, then the Federal Reserve is less likely to cut interest rates. And we've seen this dynamic shift all throughout the year. I remember earlier in the year, some analysts were considering that the Fed will cut rates in March. Obviously, that didn't happen. Then it started shifting towards June. Now it seems like it's a lot less likely that there will be a rate cut in June, and potentially we're looking at later months. And so really some of this inflation data that's coming out later this month, the PCE report, for example, a very important report that the Federal Reserve looks at, those are going to be key to set the tone for the Federal Reserve's future actions. Now, as these inflation numbers are reporting hotter and we're seeing interest rates really remain elevated, we're now seeing mortgage rates hit, just over 7% for the first time all year. That continues to give momentum to investments in like multifamily, for example, or private credit, depending on floating rate private credit or how it's structured. And so some key elements to consider as really at the beginning of the year or even towards the end of last year, a lot of the conversation was around lowering interest rates. And now that clearly that conversation is changing. So good cue to look at your portfolio and to determine are you set up correctly in this sort of shifted dynamic. Additionally, we also want to look at the fact that it's possible that the Federal Reserve could not lower interest rates, or if inflation is hotter, maybe even hike interest rates. Now, I know that's kind of out of the conversation right now, but another key point to look at the duration in your portfolio. And so how risky is your bond portfolio right now? And so really key moment to consider how you're structured from a fixed income bond perspective and where your assets are. So you often hear portfolio managers and analysts and really people on TV talk about the direction that interest rates are heading. And there's a lot of factors that play into it. And something that I like to look at are Fed funds futures. So basically, there's a futures market. It's derivatives based. I won't really get too much into the details of it. But portfolio managers and bankers look at this market to help hedge against some of the risk in interest rates and overall inflation. And by analyzing this market, you can kind of get a feel for where the analysts or really overall market sentiment is for the direction of interest rates. And so when I look at this data, I see that we've only got a few more meetings left for the Federal Reserve this year. And as this report sort of lays out, or the overall futures market, is that there seems to be a pretty likely odds of a cut in July and in September. And then when we look at November, it seems though, and this is pretty normal for the Federal Reserve, pretty unlikely that the Federal Reserve will cut in November. And then you've got December that I think is a bit of a wild card. And so now we're looking at potentially 2 interest rate cuts and 3 Federal Reserve meetings this year that those cuts can happen in. So at this next few inflation reports that we're going to get from PCE and CPI and others are going to be critical because we're really running out of time to fit in these 2 rate cuts. I mean, think about it. If we go through July and the inflation reports are still hot, of course, then we won't get cuts in July. And then depending on what happens then you've really just got September and December, because I think a November rate cut is typically out of the cards because we're in an election year. So if you got September and December, and then you're really in crunch time, because then if you've got hot data in August that reports in September, very unlikely that you're going to get cuts in September. And now you're looking at 1 rate cut, maybe even none potentially. And so it's these next few reports that we get from the Bureau of Labor Statistics and others, extremely important for setting the tone for where interest rates are going to be headed. So really in closing, with the Iran-Israel conflict de-escalating, we are seemingly heading in a more positive direction in regards to that issue from last week. Earnings is going to be a top market focus for the rest of the week. The Magnificent Seven earnings, again, are something to keep your eyes on. And then we've got some inflation data that many will be focused on. And so on next week's Money Minute, I'm sure we'll recap the Magnificent Seven earnings, along with many other topics. Thank you so much for tuning in. I hope to see you next week.